Hey everyone, it's InvestorZilla with a fun topic today. I want to ask a question. Is Dave Ramsey wrong about single stock investing? Now, there are a lot of things that I really like about Dave, especially like getting out of debt and his baby step plan for helping people get out of debt. But there are also some things that I don't always agree with him on. But before we get into this, please take a second and let me know your thoughts about this. And as always, like, comment, and subscribe to help me build this channel. So, this is a comment directly on Ramsey Solutions website. I'm going to jump right to the highlighted area where he says, let me be clear here. I do not recommend investing in single stocks. There's too much risk in having your investments tied to the performance of just a handful of companies. And unless you have a crystal ball lying around, it's very difficult to pick out the winners from the losers. Investing in stocks is more like going to a casino in Vegas. You walk in expecting to make a small fortune, you'll probably walk out with shattered dreams and empty pockets. Wow, okay, that's harsh. So, what does Dave think about, I don't know, ETFs? Well, right below that same comment, he says, I'm not a fan of ETFs either. Since they can be traded like stocks, investors usually try to time the market in the way they do with single stocks. And while they generally have lower fees than mutual funds, there are expenses like operation and transaction fees that can take a huge bite out of your returns if you're charged for them every month you invest. All right, so let's jump into this. I think he has some valid points that we'll break down, but first, let's just talk about single stock risk. What really are the risks with single stock investing? First, simply, you lose money, right? Or another thing is you lose all your money, meaning the company goes bankrupt. Maybe another risk is a single stock performs worse than a mutual fund that, for example, that he recommends. My question though is this really like going to a casino? So, truthfully, there are risks. There's no such thing as making money easily. Investing into a single stock takes a lot of work. If you're willing to put the work in, though, they can pay off for you really well. I really like to balance like what is the risk of this company going out of business with what is the likelihood this company grows and doubles my money. If the likelihood of this business not growing or going bankrupt is low, and the likelihood of this company growing is high, then yeah, I'll probably most likely add that to my portfolio. So let's just quickly talk about minimizing risk. How do you do that? You do that by researching the company. Now, I'm talking, you need to understand what they sell, their total addressable market, their competitors. In fact, I'd say it's really useful if you actually use their products and like them. You also want to keep an eye out on their balance sheet. Make sure the company has enough cash to survive downturns. Also, check out my Chewy video to see a balance sheet I did that I really wasn't comfortable with. That's a great example of one. The leadership team is so important. Who are they? What have they done? How do they cast a vision about the future of this company? And can they execute? Company culture. I've seen basically no investors care about this. But honestly, it's so important. Who knows the company better than the employees that work there? For example, look at Asana's reviews on Glassdoor. That is a company that is going to recruit top talent, and the people there believe in their leadership. They are going to succeed at a higher probability than a company with a mediocre culture, for example. And finally, diversification. Don't put all your money in just a few stocks. Now, it might pay off for you, but let me tell you, you will lose sleep when those stocks are taking a beating. You want to make sure that you're in different industries and that you aren't just all in like high growth tech stocks, for example. Another point here I want to make is you really need the right attitude as an investor. You can't be scared of red days. You can't sell when everyone else is. You need to build your position based on these fundamentals and hold through the ups and downs. If the fundamentals change, that's when you consider selling. All right, this is just something I do from time to time. It's a really subset of like the spreadsheet that I work through, but this is a small subset of my Robinhood portfolio. So what I look at is what is the likelihood in my mind of Asana hitting the $100 price target I have in 5 years. That's like my, bullish price um, in 5 years. Now, I think it's super likely. What is the likelihood that Asana does nothing, stays where it's at, or even drops to $20 5 years from now? I think those odds are super low, single digit odds or less. Truthfully, Asana will probably be somewhere between $75 and $80 3 years from now, maybe 5 years from now. But I do this for each of my stocks. The riskiest investment on here, in my opinion, is Shift Technologies. But even they have a fantastic balance sheet. They have the capital to execute and grow. It's just going to depend on the management team. Now, do I ever see Shift going to zero? Nah, probably not. But I could see this company easily hitting, $20 a share. In fact, I'd actually argue the company is severely underpriced right now. They have everything going for them. Anyway, so from when I bought these shares to now, I have a small profit, $826.75. If I were to sell these today, that is what I would walk away with profit. Now, if all these companies go down to my bear price, so like in 5 years they do nothing, actually do worst case in my mind, I would lose $9,417. But if I'm right, and these companies execute at all of them to my bull price, and honestly, I think some of my bull prices might actually be low. Like Tesla, for example, could be $3,000 a share. I've seen some projections for that. But anyway, but if I'm right, and these companies execute at the rate that I think they will, I've actually turned that $25,000 into $72,330 with a bull profit of $47,187. $187.30. It'll probably be less than that, truthfully, but sometimes some of these companies grow, like look at Tesla and the growth that it's been on. I would not be surprised if that number ended up, closer to $100,000, if that $25,000 did not 4x in 5 years. I also would be okay if the company, I ended up with a $25,000 to $30,000 bull profit. In both cases, I'm very happy. But the risk reward here is so skewed in my favor. But let's really talk about mutual funds now. Dave likes to talk about 10% returns on mutual funds. And I've seen so much hate and backlash around 10% is too much. None of them do that on that. There's just so much hate around that. But I actually think it's possible. You just have to be pickier on the ones you choose to invest into. It's almost like picking a stock, which I'll allude to a future topic we're going to talk about. But there are four scenarios here. The first one has an average return of 3%, where you profit $3,155 in 5 years. The second one is closer to what I'd actually expect a mutual fund to do. I'd actually be really happy if I was 8% or higher on my mutual funds. You'd profit $9,063. The third is a 10% Dave talks about, where you profit $11,668.73. The final one is 25%. Now, this would be amazing for a mutual fund. But as you can see, this is about what I'd hope to make on my same investment in single stock. And actually, I would actually be betting that I can beat even that 25% return. Now, I think the upside is even bigger on single stocks than even a ridiculous mutual fund. But realistically, this is an amazing return. 25% would be amazing. I'd be so happy. and super unlikely on a normal stock market years. Growth companies, you can beat these rates if you learn how to pick the right growth companies. All right, this is a mutual fund that I do own. It's VFIAX. Um, I just pulled some numbers roughly from around April of each year. As you can see, the growth year varied from -1% to 41%. The 41% was mainly due to the timing of when I took the number for 2020, where it was at the bottom of the market crash. But if you average out all of these returns, it's about 15.2% a year. Now, I have a significant amount of money in this mutual fund, and these returns are awesome, like amazing for me. But even at 15.2%, I want to keep a significant amount of money in mutual funds, but I also want to have a little bit, I want to have more upside to that in the single stocks that I pick. Another one that I own a significant amount in is this fund, and it has done so well since 2016. Look at that, the range from 68 to $173. Incredible returns. Do I think it will continue? Probably. Actually, if I last time I looked, Tesla was actually in here, and I think Tesla has a lot of growth ahead of it. The point I want to make here is that you also need to research and understand not just single stocks, but mutual funds as well. I feel too often people just blindly trust where their investments go in mutual funds. We should be equipped to understand who manages the fund, how long have they been doing, what's been the rate of return in the history, what companies is this fund invested into, and I can go on and on about things I look at. I personally treat my mutual fund picks like I do single stock picks. So Dave is right. Some people try to time the bottom and top of the market. Some people like gambling on stocks around earnings, or maybe even buying all-in options. Single stocks can be better than mutual funds. And trust me, you will feel a lot better about your investments on a red day if you believe in what the company is doing. So if you don't believe in the company, you should not invest into it. You won't be able to hold on to it through the ups and downs. So is Dave wrong here? Well, my answer to that is yes and no. He's wrong because single stock picking isn't like gambling. It's about making educated investments into companies you believe are going to grow over time. It's about long-term investing, not timing the market. It's about putting in the work to be a good investor. He's right in some regards, though, because most people don't want to put in the work to make proper single stock picks. I've known people that jump on the hype train with no fundamentals to back up where they are making their investments. If your nature is to do things like that, then I recommend you stay away from single stocks. Focus on mutual fund investing. If you don't have the mental fortitude to hold while stocks are going down, or even better, buying when stocks are going down, stay away from single stock investing. Now, I'm a long-term investor, and when I believe in a company, I ride the waves with it. I've been wrong, and I've missed a few times, and that will happen. But I take those losses and figure out where my blind spots were and get better as an investor. I'm a much better investor today than I was 5 years ago. Hope to be even better 5 years from now. So I think single stocks should be part of your portfolio along with mutual funds. I don't think it's just mutual funds. I don't think it's just single stocks. I think you need both. I personally have single stocks, ETFs, long call options, and mutual funds. It's all part of my portfolio. I really don't like that Dave just blanketly recommends against single stock investing. I think it's a bit more complicated than that. You don't need a crystal ball to see that electric vehicles are coming. You don't need a crystal ball to see a company like Asana is going to continue growing revenue. It's just not true. You just have to put in the work. All right, that's it. Hopefully this was fun and that it's been useful. If you've enjoyed this video, please share it with somebody that you know and give me a thumbs up and subscribe. Otherwise, invest safely and see you next time.